76 million ounces. That is all that stands between 576 million ounces of paper silver claims and a delivery default at COMEX. For every 100 ounces of paper silver outstanding, fewer than 14 ounces of real deliverable metal sit in those vaults. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, silver just got hit 2.4% in a single session, and the Shanghai premium just hit 12.46%. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today. COMEX silver registered inventory. The number is 76 million ounces. That is the metal carrying warehouse warrants, immediately deliverable against futures contracts. According to Blowfin Research, total COMEX silver futures open interest stands at approximately 576 million ounces. That gives you a coverage ratio of 13.4%. The 15% threshold is where exchange operators and delivery desks define elevated stress. The data is already below that. This follows a 30-day withdrawal run that pulled 1.5 million ounces out of registered vaults, a 1.9% decline in 1 month. Not a one-day event, a sustained directional drain. The timing is what deserves scrutiny, not the number itself. The timing. Registered stocks are falling while open interest remains at 576 million ounces. Those two lines are moving in opposite directions. Think about what that sequence actually means. The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last time COMEX silver registered coverage dropped below 15% and held there, silver was repricing within months. That is not opinion. That is what the historical record shows. The data is already telling you something. Let's build it out. Now let's build the full picture, because the coverage ratio does not exist in a vacuum. Gold Silver AI is reporting Shanghai silver on the SGE AG T+D contract at $83.50 per ounce. Western Spot via investing.com sits at approximately $74.07 to $74.45 per ounce. That is a premium of $9.25, or 12.46%, paid by physical buyers in China over the paper price set in New York. That is not a rounding error. That is a structural divergence. According to Trading Economics, silver dropped below $75 on Monday, following the collapse of U.S.-Iran peace talks in Islamabad and the subsequent U.S. naval blockade of the Strait of Hormuz. Silver is now down more than 20% since the conflict began. The paper market is repricing on macro fear. The physical market in Shanghai is repricing on supply reality. Those are two different markets telling two different stories simultaneously. The ones who have been saying the physical and paper markets would diverge. They are not saying much right now. The data is doing the talking. And here is what makes that picture even harder to ignore. The Silver Institute projects a sixth consecutive annual market deficit in 2026 at approximately 67 million ounces. This is documented in finance magnates citing Blowfin Research. At the same time, COMEX open interest at 576 million ounces represents paper claims that dwarf the annual global mine supply of approximately 820 million ounces. That is not a contradiction. That is the setup. And before anyone takes that as a green light, setups can take a long time to resolve. The 13.4% coverage ratio tells you where the structural pressure sits. It does not tell you when that pressure releases. Setups resolve on their own schedule. Anybody claiming to know the timing is selling something. What the data shows is the structural picture. The timing is a completely separate question. Here is the number most people are not talking about right now. 21 million barrels per day. That is the volume of oil that transits the Strait of Hormuz under normal conditions. The U.S. naval blockade activated after failed Islamabad talks is not a backdrop anymore. It is the primary variable. According to Trading Economics and Reuters, Brent crude surged above $100 per barrel immediately following the blockade activation. U.S. March CPI, reported by Financial Content, showed a 0.9% monthly rise, the largest since June 2022, pushing the annual rate to 3.3%. The Federal Reserve holds the Fed funds rate at 3.50 to 3.75%. CME Group FedWatch data shows 0% probability of an April cut. Markets are still pricing a manageable inflation path. Look at 3.3% annual CPI with a 0.9% single-month move and tell me what probability you put on that path holding. When markets start pricing the full inflation reality of a closed strait, silver reprices on industrial demand pressure, gold reprices on haven demand, the dollar reprices on real rate expectations. That is the historical pattern. Every time an energy supply shock has hit during a rate hold cycle, it has not been different yet. Silver Western spot sits at approximately $74.25 per ounce right now. Shanghai physical on the SGE sits at $83.50. That is a $9.25 premium being paid for real metal in Asia, a 12.46% gap that the arbitrage mechanism cannot close because there is not enough registered metal at COMEX to ship east without triggering delivery stress. The short-term picture is this. If the DXY holds below 99 and yields stay at or below 4.31%, silver paper has a floor in the $72 to $74 range. If the Strait situation escalates further and registered COMEX stocks drop another 5%, the coverage ratio moves toward 12%, and delivery risk becomes a headline, not just a data point. If diplomatic resolution comes and energy prices fall, the paper market trades to $68 to $70, while the Shanghai premium compresses but does not close entirely. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what silver does tomorrow. Nobody can. If you think you know, good for you. The 10-year Treasury yield at 4.29 to 4.31% per Trading Economics, the DXY at 98.40 per Yahoo Finance, and an open geopolitical variable at the Strait of Hormuz make directional conviction on a day-to-day basis unreliable. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market in both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. First, Treasury yields at 4.29 to 4.31% raise the opportunity cost of holding non-yielding silver directly. Second, the DXY recovering toward 99 would compress dollar-denominated silver prices mechanically. Third, a diplomatic resolution at the Strait of Hormuz removes the energy inflation premium and sends speculative money into equities, not metals. The bull case is equally real. First, COMEX registered coverage at 13.4% is a historically rare stress level that has preceded delivery squeeze events. Second, Shanghai physical premium at plus $9.25 signals Asian demand for real metal that paper pricing in New York is not reflecting. Third, the Silver Institute's projected 67 million ounce annual deficit for 2026 means the supply side cannot resolve the structural imbalance even if demand softens. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything shown today points to one thing. The structural pressure is already built into the vault numbers, the coverage ratio, and the Shanghai premium. The only open question is whether the paper market reprices toward physical reality, or whether physical demand in Asia weakens enough to let paper lead. Don't take my word for it. Verify every number I gave you today. Check the data yourself. CME Group COMEX warehouse stocks at cmegroup.com. Shanghai Gold Exchange SGE benchmark data at en.sge.com.cn. Trading Economics Silver and CPI data at tradingeconomics.com. Logic over hype. Always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0 out.